On September 20, 2010, a massive red sign bearing the unmistakable smiley face of Toys R Us was ripped down in New York City, signaling the beginning of the end for a retailer that had once been the kingdom of childhood imagination. In that moment, a silent alarm rang through boardrooms and playgrounds alike, announcing that a beloved empire was about to be dismantled by forces far removed from the squeal of delighted kids. Founded in 1948 by Charles Lazarus as a baby goods store in Washington, D.C., Toys R Us quickly evolved from a modest shop into the world's first dedicated toy superstore. By the mid-1970s, the company's iconic orange balloon arch and giant Geoffrey the giraffe mascot greeted millions of families each weekend, while sprawling warehouse-style locations, some covering more than 50,000 square feet, offered a dizzying array of action figures, board games, and the newest electronic gadgets. The brand became synonymous with the phrase, "I'm going to the store," and a 1990s advertising campaign that promised, "The place where kids come to play," cemented its cultural foothold. At its peak, Toys R Us operated over 800 stores worldwide, generated more than $30 billion in annual sales, and employed a legion of devoted staff who knew the exact aisle where the newest Lego set waited. But beneath the glittering storefronts, financial foundations were beginning to shift. In 2005, the company was taken private in a leveraged buyout led by two of the world's most powerful private equity firms, Bain Capital and KKR, along with real estate giant Vornado. The deal, valued at $6.6 billion, loaded the once cash-rich retailer with $5 billion in debt. The new owners argued that the infusion would spark a transformation, modernizing e-commerce, refurbishing stores, and expanding into emerging markets. Yet every dollar of profit was now earmarked for interest payments, leaving a razor-thin margin for reinvestment. The warning signs emerged slowly, then all at once. In 2013, the company announced a $250 million investment to revamp its digital platform, but the rollout was hampered by outdated legacy systems and a fragmented supply chain. Meanwhile, brick-and-mortar competitors such as Walmart and Target began dedicating prime floor space to toys, leveraging their massive distribution networks and lower price points. Online giants, led by Amazon, introduced algorithm-driven recommendations and lightning-fast shipping, eroding the very reason families once drove to a Toys R Us store in the first place. By 2015, sales growth had stalled and the company's debt service costs consumed nearly 40% of its operating cash flow. In an attempt to stem the bleed, Bain, KKR, and Vornado pushed for aggressive cost-cutting measures. Store footprints were slashed, hundreds of employees laid off, and the iconic Geek Squad partnership with Best Buy was terminated to reduce fees. Yet these moves failed to address the structural problem. A balance sheet weighed down by billions in interest, coupled with an industry that was rapidly migrating to digital. In 2017, the firm filed a Chapter 11 reorganization petition in the United States, declaring $5.2 billion in debt and seeking protection from creditors. The filing sent shockwaves through Wall Street, igniting a firestorm of criticism aimed squarely at the private equity owners, who were accused of stripping cash dividends, paying themselves hefty fees, and loading the company with debt that it could never realistically service. The collapse unfolded like a domino cascade. In early March 2018, the U.S. courts approved the liquidation of all 735 U.S. stores. On March 24, the bright red banners were lowered, the Geoffrey mascots were carted away, and the once buzzing aisles fell silent. Employees received terse notices of termination, many without severance, while families who had planned birthday parties or holiday gifts were left scrambling for alternatives. Internationally, the brand persisted in a few markets, Canada, the United Kingdom, and parts of Asia, thanks to separate franchise agreements, but the U.S. heart of the empire had stopped beating. The aftermath rippled through the retail landscape and sparked a broader conversation about the role of private equity in American business. Critics argued that the leveraged buyout model turned a cultural institution into a financial lever, extracting value through dividend recapitalizations, while ignoring the long-term health of the enterprise. Supporters countered that Toys R Us was already floundering under the weight of e-commerce disruption, and that no amount of private equity capital could have saved it without a radical overhaul of its operating model. What is undeniable is that the debt burden forced the company to prioritize short-term cash extraction over essential investments in technology, store experience, and supply chain agility. In the years that followed, the vacant spaces once occupied by Toys R Us became canvases for pop-up markets, experiential retailers, and even community centers. Former employees organized a grassroots campaign called The Return of Jeffrey, lobbying for a revival of the brand under a more sustainable ownership structure. In 2021, a consortium led by former executives announced a limited reopening of a flagship location in New Jersey, this time as a hybrid brick and online concept, promising to learn from past missteps. Though the revival remains modest, it serves as a cautionary emblem of how a beloved brand can be reshaped when financial engineering eclipses consumer relevance. The story of Toys R Us is more than a corporate failure. It is a vivid illustration of how private equity firms in pursuit of high-yield returns can inadvertently or deliberately bleed a cultural icon to death. Subscribe to The Collapse for more stories like this.